On Monday, the S&P 500 fell sharply about 1.5%, and the NASDAQ, which is a technology-heavy index, fell by about 3%. And the S&P 500 Technology Index fell by about 5%. NVIDIA, which was the largest company in the S&P 500, fell by about 18%. And in dollar terms, it was the largest decline, single-day decline of a U.S. stock in dollar terms in the entire history of the U.S. stock market. The reason for these declines was a Chinese company called DeepSeek. DeepSeek released a large language model, an LLM, on Friday of last week that was analyzed over the weekend. And a lot of people got scared by the implications of what this company released. In this video, we're going to go over why it was that the stock market reacted so violently to the release of this LLM by this Chinese company. And we're going to ask the question, very frankly, did the market overreact to this? Now, there's been many people in the financial media today that have been arguing that the stock market overreacted. And the main argument they cite is something called the Jevons effect or the Jevons paradox. And even if they're not citing the Jevons effect specifically, they're usually making arguments that are very much in line with the so-called Jevons effect. So in this video, I'm going to discuss the Jevons paradox, the Jevons effect, in order to see if it actually provides a solid intellectual basis for thinking that the stock market may have actually overreacted to this news about DeepSeek. Now, first of all, I want to get in a little bit into the history of the Jevons effect, because it's actually quite an interesting history. First of all, the Jevons effect is named after a British economist and logician, scientist and mathematician by the name of William Stanley Jevons. Now, during his career, Jevons wrote on a variety of topics, including logic, philosophy, scientific methodology, science. But Jevons is best known today as one of the greatest economists of the 19th century. He was one of the co-discoverers of the marginal utility theory of value. The development of this theory was one of the most revolutionary events in the entire history of economics. Now, something that Jevons is a lot less known for was a book that he wrote on the coal question. And this is where he brings up this thing that is referred to today as the Jevons paradox, or sometimes called the Jevons effect. Now, this book, called The Coal Question, was written in 1865. And in this book, he brings to the public's attention his concern that Great Britain might actually run out of coal supplies. And this was a very big problem because Great Britain's entire economy at that particular point in time was being powered by coal. Now, the reason that the Jevons paradox arises, and this is very important that you understand so you understand what people are talking about when they're talking about this Jevons effect as it related to AI. The reason that he wrote this book is that people at the time were saying that because there had been massive advances in the efficiency of the steam engine, such that the steam engine was now much more efficient. In other words, it was able to generate much more power with a lot less coal, then Great Britain may not actually have a problem in terms of running out of coal resources. But what Jevons argued in this book is that when a resource such as coal is used much more efficiently, what actually happens is that new uses are discovered for that particular resource, and therefore the consumption of that resource will actually increase and actually surpass the level of consumption that it would have had if that increase in efficiency hadn't occurred. So this is why it's called a paradox, because normally you would think that if a resource is exploited a lot more efficiently, then a lot less of that resource is going to be consumed. But what Jevons actually pointed out is that the opposite actually tends to happen. And as it turns out, Jevons was absolutely right when it came to coal. The consumption of coal did actually increase massively, despite the fact that there were also massive increases in the efficiency of engines and machinery that used coal. Now, all over the news media in the last few days, there's been a lot of people that have been bringing up this thing about the Jevons effect. And probably the first person to really bring it up, and it was the reason that people started discussing this, was a comment by Microsoft's CEO on Sunday night as the valuations of tech indices were really falling dramatically in overnight trade. Satya Nadella made a comment on Twitter where he said, "Jevons paradox strikes again. As AI gets more efficient and more accessible, we will see its use skyrocket, turning it into a commodity that we just can't get enough of." So you see here that Nadella is drawing a parallel between AI today and coal during the mid-19th century. So the analogy here is that AI is a resource kind of like coal. And as we learn to exploit this resource more efficiently, and as it becomes less costly to exploit this resource, and as this resource becomes more available to more people, then we're actually going to have a massive increase in the use of this particular resource called AI. And so the idea is that this AI resource that is comprised of a combination of things, it's computer chips, it's data centers, it's a whole lot of infrastructure that actually provides the base level AI products and services that various people use to create applications. As we learn how to use those resources, the chips and the AI infrastructure and the data centers and so forth more efficiently, it'll bring the cost down and it'll just cause people to use these resources more and more. And in fact, the idea is that the expansion of the use of AI will be so great that the use of this AI infrastructure will actually be greater than it would have been if we hadn't had these massive efficiencies. These massive efficiencies created by DeepSeek and others. So the idea here, for example, is that even though building an AI application takes 97% less computing power than it did just a few weeks ago, initially you would say, well, that means that people are just going to use a lot less. They're going to need NVIDIA computer chips a lot less. They're going to need a lot of data center services and so forth. And a lot of these other resources, they're just going to need less of that stuff to make these applications. But the idea here is with the Jevons effect that since the AI infrastructure has become so cheap, people create far more products and services that use AI. And so this increased usage of the AI infrastructure will actually not only compensate for the gains in efficiency, it will actually create a situation where we'll end up using even more AI infrastructure than we would have had if those efficiency gains had never been made. Now, up until this point, the argument is at least plausible in that I do think that almost unquestionably, the fact that AI resources are going to become more available to more people and they're going to be less costly to use means that people are going to develop far more applications and that there's going to be an explosion of creativity where people are going to develop more and more products and services that are powered by AI technology. Now, whether or when you'll actually get this so-called rebound effect where you'll actually fully compensate for the gains of efficiency is an open question. But I'm not going to debate that here because I do think that that is somewhat of an open question. What I think is far more interesting to do is to really think about this analogy that we have here with the coal question that Jevons dealt with. Because let's imagine a situation where Back in 1865, there had been some incredible invention whereby through the use of some sort of a device that was invented and that was very, very cheap, people could just go and get coal from just about anywhere they wanted to in England for a very low price, so that they would be able to discover reserves that hadn't been found, and reserves that were perhaps too costly to produce would now be extremely cheap to produce. And so they would be able, essentially the available coal resources would expand, because coal that was previously uneconomic to exploit would now actually be economic because it cost a lot less to actually mine that coal. Now, let's imagine the situation in which everybody pretty much has their own factory that they can extract their own coal for very cheap. What would happen to the incumbent coal producers, the incumbent coal miners, and the incumbent coal processors? They would all, their profitability would plummet, and most of them would probably actually go bankrupt, because they would all have very elevated cost structures that were there to produce coal through a different type of methodology and a different type of technology. And that method of mining coal would now be obsolete. And so those producers would only be able to produce coal at a very high price and make a profit, but prices would collapse because everybody's able to produce coal really cheaply now. So what I want you to see is that the existing coal producers are actually going to be hurt. Their profitability is going to decline, and many of them will actually go bankrupt. Now, let's now apply this analogy to AI-oriented companies in the stock market. And really, we have to look at two different levels of production here. We have to look at companies that produce goods and services at the base level of AI, and we have to go to then a second layer for a second group of companies that actually produce applications using the AI that's provided at the base level. Now, let's just start with the base level, because that's where some of the biggest big tech companies are providing essentially the infrastructure that's necessary in order to produce applications. Now, what DeepSeek has essentially just done is that a lot of companies, a lot of entrepreneurs are no longer going to need the goods and services that were previously supplied by OpenAI, by Microsoft, by Google, and so forth, because they can have their own personal LLM model that they can run out of their homes or out of their offices on their own hardware, and they don't need big data centers. They don't need to subscribe to expensive enterprise level AI plans provided by Google's Gemini, or by ChatGPT, by OpenAI. They have their own model that they can use essentially for free. And not only that, they can customize it exactly to their own specifications and exactly what they need, which is something that they would only be able to have purchasing services from Microsoft, Google, etc., at an extremely high price. In addition, these companies need a lot less computing power. They're not going to need really fancy NVIDIA chips or really fancy hardware to be able to run these AI models. They can actually do this with much cheaper computer chips, much cheaper hardware. And so producers of chips like NVIDIA and producers of different types of hardware are actually going to be hurt in this sense, because people are no longer going to need that type of infrastructure in order to produce AI applications. It's a little bit like if, when my analogy before, they had discovered completely new ways to mine coal. And so the tools that used to be used for mining coal are no longer really useful, because those tools can only produce coal in a very expensive way. Now, let's look at the applications tier, because this is really where the most spectacular developments are going to take place. Because you have to see that what's happening here is that a lot of people are now going to be able to produce products and services at the application level that they wouldn't have been able to produce before. There's a lot of entrepreneurs that simply didn't have access to capital, they didn't have the budget, they didn't have access to massive resources that they would need, such as big staffs of computer engineers and software engineers. They won't have access to the NVIDIA computer chips and so forth. Today, an entrepreneur that previously needed those types of resources plus cash and venture, from venture capital and so forth, they're not going to need any of that stuff, or they're going to need a lot less of it in order to produce the products and services that they have here in their head. And there's a lot of entrepreneurs that have huge dreams and they have huge ideas for products and services that they would like to produce. But previously, it was simply out of reach for them to do so. So this is going to create an explosion of new firms that are going to come in and produce new products and services. And of course, it's going to provide opportunity for stocks that are currently in the stock market to produce applications that are going to be very useful to people. But for the most part, we have to see that most companies that trade on the stock market are incumbent players. These are players that presumably are producing products and services right now that they produce in a very costly manner. And precisely because it was so costly, they had a moat there that previously other people weren't able to compete against them. But now there's a lot of new entrants that can come into the markets of all these different players that are on the stock market and essentially replicate the products and services that those companies are producing, or even beat them out now that they have this technology that they can work with, this new AI technology that's going to allow them to replicate and improve on the products that tech companies are actually already selling in the market right now. So for a lot of tech companies, especially software producers, this is going to be absolutely disastrous, because they're all of a sudden going to be facing all this competition, this very low-cost competition. It's going to drive their prices down. It's going to drive their profit margins down. And instead of looking at earning abnormal levels of profitability and abnormal levels of growth, they're going to be looking perhaps at earning abnormally low levels of profitability. Now, this brings up a final point that I'm going to just speak about briefly, because I really need to produce a whole new other video to talk about this particular point, but I'll just introduce it here briefly, which has to do with the fact that in the medium term, and certainly in the long term, all software is going to become a commodity. Why is that? Because AI is going to have something called, and already has something called, autonomous AI agents. Each one of these agents is essentially going to act like a software engineer. And people that have a staff of 2 or 3 engineers are going to be able to handle a staff of AI agents that might be hundreds, thousands, tens of thousands of AI agents that are working for them at a very low cost. And those AI agents will be able to take any piece of software, slice it and dice it, and reproduce it and improve on it at a very low cost. Now, we're talking in the medium and in the long term that's going to be possible, but we see that through this DeepSeek technology, we've just taken one giant step in this direction. And in fact, we've taken one giant step in the direction of AGI, or artificial general intelligence. As we get closer and closer to artificial general intelligence, a lot of software companies are simply not going to be able to be profitable, because again, new entrants are going to be able to use AI technology to replicate and improve on their product, and prices will fall down toward marginal cost. And this is exactly what economic theory predicts. Economic theory predicts that anytime you have an industry where profitability is abnormally high, you're going to get a lot of new entrants that are going to compete in that market in order to participate in that profitable market. When profitability falls to the cost of capital, you no longer have abnormal profits. And in fact, what usually you have is a situation where when you have all these new entrants, prices fall so far that profitability falls below the cost of capital. So the biggest threat to the stock market right now is that in the short run, a lot of incumbents that are already producing goods and services, they're going to see their profitability really decline, and therefore the PE ratios that they're able to command in the market are going to decline, because the products that they're producing are going to become commoditized. But in the longer term, even these new entrants that are going to come out and produce these new products and services that are going to be spectacular, and they're going to be great. They're going to be great for consumers. This is going to be a tremendous development for humanity. It's also going to be very exciting, and some companies are going to be able to, in the short term, create a lot of noise and generate some excitement and profitability with their new products. But what's going to happen is that any new exciting product that comes along, because of AI and the development of artificial general intelligence or something close to it, and the development of AI agents that are able to work at such a cheap cost, any good product that emerges is very quickly going to be replicated and is going to very quickly be surpassed by competitors. But this last stage that I talked about, which is going to be this stage where we're going to have this explosion of AI products and services coming from, all these entrepreneurs that are going to have access to this cheap AI technology and access to AI agents, autonomous AI agents that are going to create all kinds of new products and services. That's going to be in a little bit later stage. It's going to be a few years from now. Right now, the biggest threat to tech companies that exist right now in the market are going to be to the companies that provide AI base level infrastructure. I've already described how their profitability is necessarily going to decline because they're going to have to reduce prices and because they're going to actually lose a lot of customers. And then at the applications level, there's a whole lot of companies all over the stock market, small companies, medium companies, large companies that currently produce applications that new entrants are going to come in and compete in those fields because they're going to have access to AI technology that's going to enable them to replicate those products and actually improve upon them. So in conclusion here, I want us to reflect really on what the Jevons effect will actually cause in the market. Far from a situation that a lot of bullish analysts are talking about, that this is going to really be bullish for tech stocks, it's actually not. And actually, there's something really interesting that when you look at the comment made by Satya Nadella, he actually said something, and I'm not sure that he intentionally meant it this way, but it's nonetheless important because he said it. Because he said, as AI gets more efficient and accessible, we will see its use skyrocket, turning it into a commodity we just can't get enough of. Notice what he just said here, that AI products and services are going to be turned into a commodity. Now, commodity producers are never able to achieve abnormal profits nor abnormal rates of profit growth. And therefore, those kind of companies can never command high PE ratios. But that's the problem, that most tech companies command extremely high PE ratios because the market thinks that they have a moat. And as a result of that moat, they can make high returns on capital, abnormal returns on capital, and they can grow at abnormal rates of growth. But according to Satya Nadella here, what he's saying is that due to this Jevons effect, AI products and services are going to become a commodity. And so that's really the crux of this matter here. When you realize that the development of this DeepSeek technology and other technologies that are going to follow up in the footsteps of DeepSeek, because DeepSeek is just the beginning of a whole revolution here. The net effect of this revolution is that it's going to commoditize a lot of the products and services that are currently being produced by companies in the stock market. And when that happens, their valuations are going to collapse. Now, what's going to be the timing of this? I don't actually think that this is going to happen sort of right away. I don't think a lot of people actually realize how revolutionary this is going to be. Now, today we had a down day in the market, but I think we're most likely to have some sort of a technical rebound. People are going to get into this bullish talk about the Jevons effect and how, there's just going to be this explosion of AI and how that's going to be really bullish for tech. But it's actually true that there is going to be an explosion of AI, and there's going to be an explosion of AI products and services that are going to be generated as a result of AI technology becoming more accessible and more cheap. But what these commentaries are failing to see is that the producers of these products and services, and in particular the incumbent producers, their profitability is going to collapse. And a lot of those companies are actually going to go bankrupt because their cost structures are too high and they won't actually be able to compete with the newer competitors that are going to be using this new technology that's a lot cheaper to deploy. So I think that what's going to happen is that over the course of the next few weeks, but it's more like the next few months, we're going to start seeing increasing examples of companies having to slash their prices in response to competition that's coming precisely from companies that are leveraging this new cheap AI technology. And when that happens, and as people really start to realize the profound Jevons effect that's going to be going on here, what they're going to realize is the Jevons effect isn't bullish at all for the stock market. It's actually extremely bearish. But this is going to happen in a sequence. And so I'm not saying you should run out there and buy a bunch of put options or short stocks right now, because there's going to be a sequence to this, and it's going to be very important to kind of understand this sequence of events in order to be able to take advantage of this situation. So I really encourage all of you to subscribe to this channel, because I am going to be following this particular story of the Jevons effect and this effect of the commoditization of a lot of tech products and services. I'm going to be following that extremely closely here, because obviously I'm really interested in taking advantage of that for my own portfolio and for my clients that subscribe to my product, which is called Successful Portfolio Strategy. This product is offered on Seeking Alpha. And Successful Portfolio Strategy is basically a service where I provide you with my personal portfolio. I tell you exactly what I have in my portfolio, the amounts in terms of percentage and so forth, so you can follow along. And also I explain every step of the way the types of investments that I'm making and why. That's kind of what I'm here for. I'm here to help you analyze these things, particularly from a top-down perspective, and try to analyze, what does this mean for the markets? What does this mean for your portfolios? And how should you as an individual or as a portfolio manager, and also especially if you're an RIA, a registered investment advisor, some of my clients are registered investment advisors that I advise personally. How do we position portfolios to navigate this extremely revolutionary, dangerous environment, but also one that's filled with opportunities? You can't go the passive investing route anymore of just buying index funds and going the passive route. That's absolutely not going to work. That worked for many years. It's not going to work for the next 20 years, because we're going through a very disruptive period of history. And so I really encourage you to subscribe to my service and to subscribe to this channel. Thank you very much.